All right, Steve, this is an excellent question, but it's a very hard one to answer. And what I mean by that is Steve asks, what criteria do you use in power options to see the optimum time frame to roll a covered call? All right, now there's several different discussions we can have on this because there's several different ways, Steve, you might be trading a covered call position. Let's stick with our one example, NTR. I'm just going to go to my portfolio here. Let's see what portfolios we have. All right, let's go to collars and covered calls. Why not? Don't know when we put this one together. Probably past expiration on a lot of these positions. We were doing examples of Roku. Very quickly, I'm going to enter 3 covered call positions. We're going to say that we bought shares of NTR at $95. And we're going to sell a 95 call, a 100 call, and a 105. No, maybe a 90. Well, let's just do the 95 first and the 100. And we saw what the 30-day out prices were. It was about, I believe it was $2 for the 100, if I'm not mistaken. So of that NTR, yeah, let me check here. Yeah, the at the money is at $4. My apologies. The out of the money is $2.10. Let me jot that down. $4 and $2.10. Okay, so let's go back here. We're going to enter in a covered call. Now, I haven't tracked NTR, so I don't know if you could get in at 95 at any time. We're just using this as an example. We're going to buy 100 shares at 95, and we're going to sell that standard expiration April 95 call for the current, what the current at the money price is at $4. Okay, so this is started off as an at the money covered call position. And it is now in the money by $4.65. We sold it for $4. It's going to cost us $6.80 to buy it back. Okay. Now, we're in the money. And my max expected return at expiration. What is the max expected return on a covered call? Of course, if the stock stays above the position and I was going to be assigned on the position. The stock was trading above 95, we get assigned. The maximum return we could make on the position is 4.4%. Why I'm bringing this up, and it was kind of obvious for those of you trading covered calls, but why I'm bringing this up is because if this was my position, I likely set out to do a monthly covered call 45 days out from the date we put in of March 8th to April expiration. But it's because I was maybe looking for a 4% return or higher on my trade as part of my direct trading plan. Now, what is this showing me on power options? That my liquidation value right now is 2%. Well, this means if I bought the call back right now for $6.80, sold the stock at $99.65, we'd make $185 or 2%, less than half of what I expected to make. That is telling me something there, Steve. That's telling me right now that if I rolled this position, I'm paying half the time value back into the trade right now without taking advantage, of some of the intrinsic movement upwards. But I'm still paying into 2.4% time premium to buy this call back right now. I would typically want to wait for that, Steve, to be lower. Okay, I want it to maybe drop down below 1%. That's one of the topics we discussed when to look to roll or close a position. And so now when I go to position actions and position analysis, you see here, well, it's about 2.2% left in time value. I typically like that to be below 1 when I go to roll the position. But again, Steve, that comes down to a different point that we're going to get to in just one moment. Now, sure, there are reasonable rollout opportunities that are available. I can roll out 1 week to higher strikes in April and increase my 4.4 expected max return and only 2% return now if I liquidate up to 6.6%, still have a 52% probability, a potential 7.2%. And in this case, I'm still being able to roll to a credit. Why I'm showing you this is this mainly is because it's a very powerful tool to help you evaluate rollouts if you're considering rolling. But again, what this has to do is match your trading plan. That is key. And what do I mean by the trading plan again? If I had gone set out with this portion of my portfolio, where I'm looking to make 4% every 40 days or so with covered call positions. I know I should have probably just done 30 days and said, yeah, we opened this position, today for the price there. But if my target is 4% over 40 days, and that's what I was originally expected, and if I just let it get called away, of course, then yeah, I'm going to make my 4% and I'm going to hit my target. But let's say you're doing out of the money calls, or at the money calls, excuse me. You wanted the higher premium to take advantage again of that at the money bell curve, and something exceeds your expectations, and now you're in the money and you're looking to go back to sort of this at the money range. And in this case, that's what you'd be looking to do. But if I have 27 days to expiration right now, if I increase it by another 8 days to 35 and move it up to 6.6%, which would be a positive 2.2% gain of the max return I have now, that would probably be a check. And in this case here, it still probably would match that, just an additional 8 days more, increasing from 4.4 up to 7.2. Well, that's a 2.8% gain for just an additional 8 days. That's probably within my trading plan as well, Steve, at that point. But depending on my outlook for the stock, Ernie's suggestion and what we discuss often is that you typically want to look to roll the position or close the position if you've reached 80 to 90% of what you expected to make. We're only at 46.3% here. And when the time value is less than 1%. Now, this might be different for a weekly. I'm using a monthly, because if I'm using a weekly, at the money, out of the money covered call, my return probably wasn't 4%, right? It was probably 0.8, 0.9, maybe a 1% yield. So in that case, if you're using weeklies, you're probably looking for the time value to be lower than 0.2 or maybe 0.3, something along those lines where you've made 70 to 80% of the time value that you'd expected on the position. That's a good time to roll because you're not paying into a bulk of time value to now roll this position. That's one feature that you might use. Now, that, again, is based on when we look to roll. Typically, because of what I just discussed a little bit with the at the money bell curve, Steve, I don't like, if I had sold the out of the money, I apologize, let's add that one in. I covered call position, NTR once again, 100 shares, 3,895. We're going to stay with 30 days out in time, and we're going to do the 100. So this was out of the money. And based on what we saw, the price would be at around $2. Let's just call it $2 in that case. Okay, so now that the stock is right at the money, it's at 99.65, Steve, and we're holding that 100 call. The ATM bell curve is starting to take effect. We're getting closer to at the money, so that extrinsic value is swelling. It's increasing in value. So I actually have to pay more to buy this position back than I originally received. Now I need to find a premium that's higher than $2 going out, of course, at a higher strike price probably as well in this case. So again, let's go to position actions and position analysis. They're probably good roll opportunities that are available, but you see they're not as strong. Some of these are at a debit. Some of these are at a very low net credit. We are increasing our return. The initial expected return was 7.5%. So we're not getting that much because the time value, the extrinsic value, I should say, on this, Steve, has increased in this case. We started out of the money. We started above the current stock price. Now the stock has gone up to our strike price. We're at the money, and we have the highest time value right now of all options in this April series. Not the ones further out in time. I'm just saying on this April series, we've got the highest time value right now that you have to buy back into. Again, on the ATM bell curve, any option, same expiration, the option that's right at the money is going to have that highest time premium. Related to calls, in the money is going to have a higher price naturally, but you're paying for intrinsic and extrinsic, and the extrinsic is going to be lower. And out of the money options are going to have the lower extrinsic value as well. So when I'm buying back, I don't necessarily want to buy back at the highest peak of time value at that time. Ernie and I tend to let this position go a little bit more in the money. We're going to go a little bit this way, allow it to go in the money. So yes, I'm paying a higher price intrinsically, absolutely. But again, now the time value is lower. And if I roll this now at the money, I buy back here when it's slightly in the money, and I sell a higher strike that's at the money, I'm getting the time value gain that I want. I'm going back to at the money at the current price. Now, this one I know is right at the money. But again, that's why I would look for this one. Remember, this is the 100 strike that we sold initially. It was an out of the money, just one strike out of the money. When we opened the position at 95, I'm sorry, let me go back here. Take a look at the profit and loss chart. And now the position is right at the money. And we're looking pretty good on the position. We have a small profit on the position. But again, the target was much higher. It was 7.5%. And if I let this go a little bit more in the money, what else is going to happen? We're going to be getting closer to that liquidation value. We're going to be getting an increase there as we let it go slightly in the money. And right now it's about half, a little bit less than what we expected for the liquidation value in those cases. So to take advantage of the ATM bell curve, once it starts going up and it starts going a little bit in the money, that's when I'm going to look to adjust it. I want to buy back into the lower and then sell to the next at the money price, if that's your approach. Okay. A lot of the covered calls that we have on power options, Ernie's picks of the day, for example, start off as in the money covered calls. We don't typically look to roll those positions. We just want to let them get assigned and earn the maximum return. But if you're selling out of the money covered calls on stocks that you want to own long term, maybe just to help increase, maybe treat it as a monthly dividend, month by month, to collect a dividend against the position using out of the money calls, that's fine. Although you don't want to be assigned, whether it's for tax purposes or you still want to hold on to the stock position, I know the concern, the saying, well, Mike, why would I let it go in the money? I can be assigned at any time. But I also don't want it to go right at the money and then be paying the highest time value at that time of all options on the chain for that expiration. I'd rather let it go slightly in the money. Yes, I'm paying more intrinsically, but I'm trying to play the time value game in this case. We're looking for time value gains over time. And that's why we'd let it go slightly in the money. Now, of course, you could develop a trading plan. You know, if you bought this at 95, again, I'm sorry, and we sold a further out of the money 105 call. Now, that would have been probably only $1, let's just say, okay? Yeah, we're 10 points out of the money here, 2 full strikes out of the money, essentially. And so now that the stock's at 100, you could say, okay, well, now that this has probably gone up to, let's say, 140 or 150, I'll buy that back and now roll up to the 110. So you're trying to keep a 2-strike advantage. That could be doable too. I'm not going to say it's the proper time. I don't think it's the best time for what you asked. When is the best time to do it? Again, just learning from Ernie and what Ernie's done over the many years he's traded covered calls. And of course, we take this same approach, Steve, when we sell a call against the married put position. As it starts to move up, we'll let it go in the money slightly so that we're on the other side of that ATM bell curve, and we'll look to roll it then at that point to keep the time value game in our favor. But if you have, again, a criteria and a trading plan you're using where you're buying stocks and you're selling 2 strikes OTM or maybe even 3 strikes OTM, and you have a trading plan where if the stock moves to the next strike, so it moves up to 100, that's when I'm going to get rid of this 105 and go up to the 110. That could work as well, but same thing, you're probably going to be paying more than you originally collected. And again, like I said, we would still look for maybe that percent time value on a monthly to be less than 1%, as is shown in the position analysis view when you first link to the position analysis view on any of those positions. Let's go back to that. Let's clear out the drawings a little bit. Here we go. Yeah, and so this one here still has that 4% time value. I want to wait a little bit longer if possible. This is not truly in the money yet. It's right at the money, but I want to wait a little bit longer if possible, let it go in the money so I'm paying less into that time value premium on the position. I still have 40 days to go on this trade, right? 35, excuse me. So we still have time left on this position. So I want that time to be in my favor. That's why I sold the call, is to get the time in my favor. But that's our typical approach. Time value, percent time value of less than 1%. Let it go potentially a little bit in the money. Try not to buy it back at the money because that's when it has the highest time value of all the options around it. Yes, you're going to be rolling further out in time, I get it, but you're paying into the one that has the highest time value. And again, if your approach is to use out of the money calls, Steve, and just hold the position long term, not let it be assigned, then you could probably use that method I mentioned where, I buy the stock, I sold the out of the money call. I want to stay 2 strikes out of the money. So if it moves up to the next strike level, it moved from 95 to 100. I might now close my 105, roll out a week or 2 weeks, what's available there, and move up to the 110 price. Okay. Yes, there is a risk in some cases of allowing the position to go slightly in the money. If you're worried about assignment, you do run the risk that you could be assigned early. That happens, doesn't happen that often, but you want to know where your ex-dividend date is, because if you're slightly in the money and your ex-dividend date's coming up, then of course, that's where you may run into it as well. And other features, of course, we can use here in the alerts column. We can click on view if this was my position, and we could set it and the option percentage change up or down. The range in the money, for example, that's something that we added recently, and the ask time value. Okay, so the percent time value limit. If that drops below 1%, I want to be notified that it's in my favor. That's when I might look to roll the position. And then, of course, since this was the 105, I'm sorry, this was our 100 call that's now right at the money. So I could set it, hey, if it goes more than 3% in the money, for example, let me know. And we could also use, I'm sorry, I'm looking for another one that I wanted to see, not the stock percentage change there. Yeah, I'm sorry. I was looking for something different that I use in the spreads, not for the covered calls here, when to roll that call. So that's the approaches that you might consider. Oh, you could also use the stock price. That's one common thing I use. So what was this? We bought the stock at 95. We sold the 100. So if the stock, let's say, goes above 104, is entering into that next range, that's probably when I'm going to look to roll a position. Yeah, not just 101 or 102, probably a little bit more closer to that next strike movement in the money. So yes, I'm paying more intrinsic, but I'm trying to not buy back at the money where I'm paying the most time value in those positions. Yes, the stock limit, ask percent time value, you could set that for your covered calls, or cash secured naked puts, same kind of approach. And the in the money limit, or even the delta, if you wanted to use that, you can now set the delta in. If I originally opened the covered call with a delta of 0.4 and I want to be notified if the delta goes to 0.6, slightly in the money, then I use the option delta limit as well, upper limit of 0.6 for the call. Okay, so set the alerts there. Watch the position analysis for the time value, but the alerts will notify you that as well. I just favor not trying to buy back right at the money because of the ATM bell curve. I like to let it go a little bit in the money. But if you're doing a different approach, as we all know, there's 3 ways to trade covered calls. I can trade at the monies, getting a high time premium with a 50-50 probability of getting assigned and making that return. Let's go back to the NTR chain for April real quick. I shouldn't have closed that. And we could sell in the money. So we'll go to standard April expiration, even though we have weeklies. So the at the money, what do we have here? We have a time value of 4%. What is it? It's the highest. Let's go to a medium chain. Sorry. There we go. 4% time value right now at the money, the 100 with a stock at 99.65. That's the highest time value. And then you can see time values get lower. We're at the peak and time values get lower. The price gets higher because it's intrinsic value. But again, the 3 ways to approach a covered call trade, of course. Buying the stock today, switching gears, buying at 99.65, selling an in-the-money call, still looking at about a 1.3% time value. Let me just go to the calls. That's going to be a better view. Fantastic. Why the calls here? Because on the call chain, as you know, on Power Options, we show the returns highlighted here if you traded it as a covered call. Your percent if assigned midpoint, the max return if you're assigned, the downside protection, and the percent if unchanged. The percent if unchanged, of course, is equal to the percent if assigned if you're doing in the money covered calls. In any case, buy the stock at 99.65. Now, I might not sell this one, but if I sold the 90 deep in the money call, it's a 1%, 1.1% return, but comes with an 11% downside protection. And as an 82% probability, the stock will remain above 90 and will make that 1%. So lower return, great downside protection, higher probability. The at the money gives us that highest time value. Yeah, I probably would use the 95 in this case for 30 days. Definitely want to be there at 2.3%, not at 1. 1% might be a weekly or 2 weeks out. But yeah, for a monthly, I want to be around more than 2.5, 3% if possible. But anyway, the at the money. Reasonable downside protection. Good potential return if assigned. 4.6% for 27, 28 days out, but only a 50-50 chance of getting assigned and earning that return. Going 2 strikes out to the 110, 113 premium. Very small time value, of course. 1.1% downside protection. And an about 11.7% return if assigned, which is all intrinsic, meaning we get the 10 points there, plus we keep the 113. That gives us the 11.7%. But only an 18.6% theoretical probability that we'll get assigned and earn that return. There are investors that just trade the in the money, maybe looking for a higher return here, but they want the better downside protection. Jay, not married to the stocks, get assigned at expiration, and then the following Monday look to open new positions once that money is freed up. That's all they're looking to do. Good downside protection, good reasonable return if assigned. At the money covered call traders are trying to maximize the time value that we just discussed. They've got the highest time value, still a reasonable downside protection, but it's only a 50-50 shot if they get assigned. Sometimes they'll roll it if they still like the stock, if they still like the premium that's available. Other times, if it does go up, they'll just let it get assigned on the position. And then, of course, the out of the money can be done by 2 different ways, 2 different types of investors. Either an investor who's looking for really high potential covered call percent return and is really bullish on the position because they're not getting really any downside protection. They're not getting any real hedge against the price of their stock by more than 1 or 2 points on a $100 stock, or maybe 60 or 70 cents on a $50 or $60 stock. But they're looking for that higher return. And of course, if it doesn't go up there and it expires, they'll just sell another out of the money call against the position and just keep doing that. Okay? So those are and then of course, the other type of investor that does it this way is the one who, maybe like you, Steve, has shares of stock they've owned for a long time that they don't want to be assigned. Maybe it's not in a cash sheltered portfolio or IRA, for example, and they don't want the tax burden of the assigned price. I had a gentleman on discussion 2 weeks ago. He was in Apple, and I think his cost basis was 52. And so, he had several thousand shares, 2,000 or 3,000 shares, I think, with a cost basis of 52. He's selling covered calls, but he doesn't want to get assigned because it's not in a sheltered account. He'd face the tax burden for those gains on those 3,000 shares, and he doesn't want to deal with that. So had a similar discussion of when to roll, when you might want to roll, and so forth. So that's just the 3 ways that one might consider trading a covered call. And again, I only bring that up because, Steve, this might help you with your thoughts on which level are you at. That also does help dictate when you might consider rolling the call. But in all 3 cases, I'd say if your position is right at the money and it has the highest time value, I don't know if I'd roll right at the money. I'd let it go a little bit in the money to see that time value decrease. And for further discussion on that, of course, let's go on now over to the playlists here. And in the playlist, you can go to the covered calls, strategy, approach, and management. I'm going to click on this, but if it starts playing right away, I'm going to stop it immediately. Sorry about that. Okay, so let me go back here and I can do it this way. Let's see here. Let's go pause the screen for a second. I'm going to go directly. I'm logged in. It's power options, but there's maybe some information that might come up I don't want you guys to see necessarily. There we go. Okay, so this is how my view of it. When you go to the playlist, I'm sorry. Phenomenal. There we go. Okay, so why I wanted to show you this is there's further discussion there on why use in the money covered calls and calculating the best strike price for a covered call. That's a better review, another review of what I just talked about briefly, about the 3 ways you might approach a covered call trade based on your risk tolerance, your trading goals, and more. Tools for rolling and finding covered calls. Here you go. This one's 12 minutes long, Steve. Triggers for rolling a covered call. You might have already seen that one. There's some here on, to roll or not to roll within the money covered calls, and to roll or not to roll with out of the money covered call positions as well. There's also discussed the ideas, but I think this other discussion here on triggers for rolling a covered call might be a good one for you to check out. But go through some of these other ones here if you have the time on the playlist to reinforce the concepts we just discussed here in this brief discussion. Of course, remember, though, that the lot of power here in using the portfolio tools. We talked about not only being able to see where I stand right now versus my future expiration date or max expected profit in the stock analysis view for these covered calls, naked put positions, and others, but also setting the alerts there to be notified when you're slightly in the money, when your delta's changed, and we have less than that 1% time value. And also, of course, using the position actions to position analysis to see what rollout opportunities are there, and do the rollout opportunities meet your trading plan for the targets you're attempting to achieve or hoping to achieve with this particular strategy in that portion of your portfolio.